All right, everyone, gather around. Today, we're tackling one of the most fundamental tools in your CFA toolkit, the balance sheet. Think of the balance sheet as a snapshot of a company's financial health at a specific moment in time. It's like taking a financial selfie. You get to see exactly where a company stands, what it owns, and what it owes. This is crucial because as analysts, our job is to dissect this information, evaluate a company's liquidity, solvency, and overall financial well-being, and figure out what it all means in the real world. But let's not get ahead of ourselves. Understanding the balance sheet isn't just about cramming for the CFA exam. It's about getting your head around the essentials that'll help you make smart decisions when you're out there in the financial wild. So buckle up. We're diving into everything from intangible assets to goodwill, financial instruments, non-current liabilities, and finally the analytical tools like common size analysis and ratios that tie it all together. All right, class, let's talk about intangible assets. Those sneaky, non-physical assets that can pack a real punch on a company's balance sheet. Now, these aren't things you can touch or see, but don't let that fool you. Intangible assets like patents, licenses, franchises, copyrights, and trademarks can be some of the most valuable assets a company owns. So, let's break this down. There are two main ways intangible assets come into play. They're either internally created or acquired from another company. This distinction is really important because it determines how these assets show up or don't show up on the balance sheet. First off, let's talk about internally created intangible assets. Under both IFRS and US GAAP, if a company creates these assets on its own, like developing a new technology or building a brand from scratch, those costs are generally expensed right away. That means you won't see them sitting on the balance sheet as assets. Why? Well, the accounting standards take a cautious approach here. The future economic benefits of something like a new software development project can be tough to pin down, so the costs just get written off as they're incurred. But wait, there's a twist. Under IFRS, there's a bit more flexibility. Let's say your company is working on a new product. IFRS tells us to split this process into two phases, the research phase and the development phase. During the research phase, when you're just exploring ideas and trying to figure out if something's even possible, all those costs are expensed. But once you hit the development phase where you're actually building prototypes and getting ready to launch, those costs can be capitalized, meaning they get turned into an asset on the balance sheet if you can meet certain criteria. For instance, you need to show that the project is technologically feasible, you intend to complete it, and you have the resources to do so. If you can't meet those criteria, then sorry, those costs get expensed. Let's pause for a second to consider a real-world example. Imagine a tech company is developing the next big thing in smartphone technology. During the initial research phase, all those costs, hiring experts, testing new materials, and so on, are expensed. But once they move into full-scale development under IFRS, they might capitalize those costs, turning them into an asset. This can make a big difference in how the company's financials look to investors. Now, what about acquired intangible assets? When you acquire an intangible asset, let's say your company buys another company's patent or customer list, that's a different story. These assets get reported separately on the balance sheet if they meet certain criteria. The asset must either arise from a contractual or legal right, like a licensing agreement, or it must be separable from the company, meaning you could theoretically sell or transfer it even if you don't plan to. Here's another real-world scenario. Your company buys a customer list from another business. That list can be capitalized as an intangible asset because it's something you can sell or transfer, even if you don't intend to. Now, that's a real asset, literally. But here's where things diverge between IFRS and US GAAP. Under IFRS, companies have the option to measure intangible assets using either the cost model or the revaluation model. The cost model is straightforward. You keep the asset on the books at its original cost, minus any accumulated amortization or impairment losses. But if you use the revaluation model, you can adjust the asset's value up or down based on its fair value. This is only allowed if there's an active market for the asset. So if the asset appreciates in value, you can reflect that on the balance sheet. Under US GAAP, things are a bit more conservative. Companies can only use the cost model, so once you record the asset at cost, that's pretty much where it stays, minus amortization and impairment. There's no revaluation option here, even if the asset's market value skyrockets. Now, let's talk about the costs that usually get expensed no matter what. There are certain costs that, under both IFRS and US GAAP, almost always get expensed rather than capitalized. These include internally generated brands or customer lists, stuff you build up within your company, startup costs, getting a new business or project off the ground, training costs, teaching your team new skills, administrative overhead, general running costs that don't tie directly to any specific asset, advertising and promotional costs, spreading the word about your product, relocation and reorganization costs, moving the business or restructuring it, redundancy and termination cost, laying off employees or closing parts of the business. These costs are like the everyday expenses of running a business. They hit the income statement right away. And let's not forget about the intangibles that aren't identifiable. Some assets are intangible, but they don't get reported on the balance sheet separately because they're not identifiable on their own. Think about things like goodwill that arises in a business combination, or how about management skill or good reputation? These are critical to a company's success, but you can't really put a price tag on them, so they stay off the balance sheet unless they're part of an acquisition. Now on to amortization and impairment. Intangible assets with a finite useful life, meaning they're going to provide value for a certain number of years, are amortized over that useful life. This is just a fancy way of spreading the cost over time. But don't forget, the amortization method and the useful life of the asset need to be reviewed at least once a year to make sure they're still accurate. For assets with an indefinite useful life, like some trademarks or brand names, you don't amortize them. Instead, you test them for impairment at least annually. If the asset is impaired, meaning it's lost some of its value, you've got to write it down on the books, which impacts your earnings. All right, let's move on to goodwill, a term you probably heard thrown around a lot in the business world, but what does it really mean? Think of goodwill as the premium you pay when you buy another company. It's like paying extra for the name, reputation, customer base, and all those intangible qualities that don't show up directly on the balance sheet, but are crucial to the company's success. So what exactly is goodwill? Goodwill comes into play during a business combination, basically when one company buys another. Let's say your company decides to acquire a competitor. You've done your due diligence and determined that the fair value of the competitor's net identifiable assets, things like cash, equipment, inventory, is $10 million. But you end up paying $12 million. Where does that extra $2 million go? That's goodwill. Goodwill is the difference between what you paid for the company and the fair value of its net identifiable assets. But it's not just a random number. It represents things like the company's strong brand, loyal customer base, skilled workforce, and maybe even its strategic location. Stuff that's tough to quantify, but adds real value. Now let's get into two important types of goodwill: accounting goodwill and economic goodwill. Accounting goodwill is what we've just talked about, the amount you record on the balance sheet after acquiring another company. It's based on the standards set by accounting bodies like IFRS and US GAAP. Accounting goodwill only shows up when an acquisition occurs. You won't see it on the balance sheet unless one company has actually bought another. This goodwill is capitalized as an asset on the balance sheet and isn't amortized but tested annually for impairment. If an impairment occurs, the goodwill value is reduced and the impairment loss is recognized in the income statement. Economic goodwill, on the other hand, is a broader concept. It's not something you'll see on the balance sheet, it's more theoretical. Economic goodwill reflects the overall value of the company based on its performance in the market. It's captured in the stock price, representing the company's ability to generate future earnings above and beyond what you'd expect based on its tangible and identifiable intangible assets alone. So while accounting goodwill is recorded during acquisitions, economic goodwill is ongoing and fluctuates with the company's market performance. Here's where it gets interesting. Under both IFRS and US GAAP, when you acquire another company, the goodwill you paid for gets recognized as an asset on your balance sheet. But, and this is a big but, goodwill doesn't get amortized like other intangible assets with a finite life. Instead, it's tested for impairment at least once a year. So, what's impairment testing all about? Impairment testing is basically a check to see if the goodwill you've recognized is still worth what you originally thought it was. If the company you acquired isn't performing as well as expected, or if the market conditions have changed, you might find that the goodwill is impaired. In other words, it's no longer worth as much as it was when you first recorded it. When that happens, you need to write down the value of the goodwill, which reduces your earnings for that period. This is known as an impairment loss. Now here's the kicker. Even though an impairment loss hits your income statement, it doesn't involve any actual cash outflow. It's a non-cash item, which means it's just an accounting adjustment. Imagine your company acquires a popular coffee chain. You pay a premium for the chain because of its strong brand and loyal customer base. That's your accounting goodwill. But let's say a couple of years later, a new competitor enters the market and your coffee chain starts losing customers. You do an impairment test and realize that the goodwill is no longer worth what you initially thought. You'll need to write it down, which lowers your reported earnings. However, this doesn't involve any actual cash leaving your bank account. Why does goodwill matter so much? Goodwill is tricky because it's based on management's judgment, especially when it comes to impairment. The estimation of fair value involves significant management judgment, which means different companies might treat similar situations differently. This can affect the comparability of financial statements across companies, which is something you, as an analyst, need to be aware of. As analysts, we often adjust for goodwill when comparing companies. For instance, you might remove goodwill from balance sheet data when calculating financial ratios, or you might ignore impairment losses when analyzing a company's operating trends. Why? Because these adjustments can give you a clearer picture of a company's core performance without the noise created by changes in goodwill. When you're calculating goodwill during an acquisition, you start by determining the total cost to purchase the target company. Then you measure the fair value of the acquiree's identifiable assets, liabilities, and any contingent liabilities. Goodwill is the excess amount over the fair market value of these net identifiable assets. And what if the reverse happens? Sometimes you might find yourself in a situation where the value of the net identifiable assets you acquire is actually greater than the purchase price. This is called a bargain purchase, and it's pretty rare. Instead of recognizing goodwill, you'll report a gain in the income statement during the current period. It's like getting a discount on your purchase. A sweet deal. All right, folks, now let's shift gears and talk about financial instruments, the bread and butter of financial markets. These are the contracts that give rise to a financial asset for one entity and a financial liability or equity instrument for another. This includes everything from investments in stocks and bonds to those more complex beasts like derivatives. So, what exactly are financial instruments? At their core, financial instruments are essentially agreements involving the exchange of money or other financial value. There are three main types you'll need to understand: financial assets, financial liabilities, and derivatives. Financial assets, these are things like stocks, bonds, or notes issued by another company or a government entity. They represent ownership or a right to future cash flows. Financial liabilities. On the flip side, these include things like bonds or notes your company has issued to raise money. They're obligations that require you to deliver cash or another financial asset to someone else. Derivatives. Now, derivatives are a bit trickier. These can be classified as either assets or liabilities, depending on the contract terms and current market conditions. A derivative's value is based on some underlying factor, like an interest rate, security price, or exchange rate. They usually require little or no initial investment, but can be extremely powerful and risky depending on how they're used. How do we report these instruments? When it comes to reporting financial instruments, you've got two main options: fair value and amortized cost. These methods can significantly impact a company's financial statements, so it's crucial to understand the differences. Fair value is essentially the price at which you could sell the asset or settle the liability in an orderly market transaction today. This is often the go-to measurement for things like trading securities or derivatives. Let's say your company holds shares of another company's stock for trading purposes. At the end of the reporting period, you'd measure these shares at their current market price, reflecting any unrealized gains or losses in your income statement. Amortized cost is a bit more nuanced. It starts with the amount at which the financial instrument was initially recognized and then adjusts for principal repayments, any amortization of a discount or premium, and any impairment losses. If your company holds a long-term bond with the intent of holding it to maturity, you'd measure it at amortized cost, meaning you'd gradually recognize the bond's face value over time, adjusting for interest payments and any potential impairment. How do we classify financial instruments? Under IFRS, financial instruments can be measured in three ways after initial acquisition. To measure an asset at amortized cost under IFRS, it must meet two criteria. The business model is to hold the financial assets until maturity. The contractual cash flows are solely payments of principal and interest. A long-term bond held until maturity fits this category perfectly. No unrealized gains or losses show up on the balance sheet or income statement. Everything gets recognized as cash flows occur. Fair value through other comprehensive income, FVOCI. If the business model involves both selling the financial asset and collecting contractual cash flows, you'll measure it at FVOCI. Here, unrealized gains or losses are recognized in other comprehensive income, not directly in profit or loss. Imagine a debt investment that consists solely of principal and interest payments and is likely to be sold before maturity. Any changes in its value would be recorded in other comprehensive income. Fair value through profit or loss, FVPL. This category includes assets that don't meet the criteria for amortized cost or FVOCI. Unrealized gains or losses here are recognized immediately in the profit or loss. All equity investments, except those with significant influence, are typically measured at FVPL under US GAAP. This is also where you'd classify debt securities that you intend to trade frequently. Let's talk about US GAAP. Under US GAAP, the classification is similar, but with some key differences. Held to maturity securities. Similar to amortized cost under IFRS, these are debt securities that you intend to hold until they mature. Available for sale securities, equivalent to FVOCI, these include debt securities that you might sell before maturity. However, unlike IFRS, this classification is only applicable to debt securities. Trading securities, equivalent to FVPL, these are debt and equity securities that you plan to sell in the short term, and they're measured at fair value with changes recognized in profit or loss. Let's move on to non-current liabilities. These are the obligations that a company doesn't expect to settle within 1 year or one operating cycle, whichever is longer. Think of these as the long-term promises your company has made, like borrowing money to finance a new project or issuing bonds. Long-term financial liabilities include loans or bonds payable that are due after 1 year. The key thing to remember here is that these liabilities are usually reported at amortized cost, meaning they're adjusted for any principal repayments, discounts, or premiums. At maturity, the amortized cost of a bond should equal its face value. Let's say your company issues a bond with a face value of $1 million and a 10-year maturity. Over the 10 years, you'll gradually amortize any discount or premium so that the bond's book value equals $1 million at maturity. Deferred tax liabilities arise from timing differences between the tax treatment of income and expenses and their treatment in financial reporting. For example, when there's a difference between the tax expense reported on the financial statements and the actual tax payable to the authorities due to timing differences. Imagine your company uses accelerated depreciation for tax purposes, but straight-line depreciation for financial reporting. This creates a situation where your taxable income is lower in the early years, leading to lower taxes payable now, but higher in the future, creating a deferred tax liability. A company with high long-term debt relative to its equity might be taking on more financial risk, which could affect its ability to weather economic downturns. For analysts, non-current liabilities are critical for understanding the company's leverage and risk profile. For instance, high long-term debt might signal that a company is aggressively financing growth, which could be a good thing, or it could be a red flag if the company doesn't have the cash flow to support those obligations. Let's now move on to common size analysis of the balance sheet. This is a powerful tool that restates every line item as a percentage of total assets. It's like looking at a company's financial position through a magnifying glass. You can quickly see which accounts have grown or shrunk relative to the company's overall size. Common size analysis is incredibly useful when you're trying to compare companies of different sizes or track a single company's financial position over time. By converting everything to percentages, you can quickly see which accounts have grown or shrunk relative to the company's overall size. How does it work? You simply take each line item on the balance sheet and divide it by total assets. For example, if cash is $100,000 and total assets are $1 million, then cash represents 10% of total assets. Let's say you're comparing two companies. One has 30% of its assets in cash and short-term investments, while the other has only 5%, this might indicate that the first company is more liquid and has more readily available funds, whereas the second company might have its assets tied up in long-term investments or physical assets. If you're analyzing a tech company, you might see that a large percentage of its assets are intangible, things like intellectual property and patents. This would be very different from a manufacturing company where most of the assets are physical, like machinery and buildings. Finally, let's talk about balance sheet ratios. These are your go-to tools for assessing a company's financial health. There are two main types of ratios you need to know: liquidity ratios and solvency ratios. Liquidity ratios include the current ratio, quick ratio, and cash ratio. These ratios tell you how well a company can meet its short-term obligations. Current ratio is the big one. The current ratio is simply current assets divided by current liabilities. A higher ratio indicates greater liquidity, meaning the company is in a better position to meet its short-term obligations. Quick ratio, or acid test ratio, takes the current ratio a step further by excluding inventory from current assets, focusing on the most liquid assets, cash, marketable securities, and receivables. Cash ratio is the most conservative of the liquidity ratios, looking only at cash and marketable securities. Solvency ratios measure a company's ability to meet its long-term obligations. These include the long-term debt-to-equity ratio, debt-to-equity ratio, and the total debt ratio. Long-term debt-to-equity ratio tells you how much of the company's financing comes from long-term debt versus equity. A higher ratio indicates more leverage, which could mean more risk. Debt-to-equity ratio is similar to the long-term debt-to-equity ratio, but includes all debt, both short-term and long-term. Total debt ratio looks at total debt as a percentage of total assets, giving you an idea of how leveraged the company is. Financial leverage ratio compares total assets to total equity and tells you how much of the company's assets are financed by equity. Imagine you're looking at two companies in the same industry. One has a high current ratio, meaning it has a lot of liquid assets relative to its liabilities. The other has a low ratio, which could indicate potential liquidity issues. On the solvency side, if one company has a high debt-to-equity ratio, it might be taking on more financial risk by relying heavily on debt to finance its operations. While ratios are powerful tools, they're not without their limitations. Ratio analysis involves a significant amount of judgment and context. For example, the current ratio might give you a rough idea of liquidity, but it doesn't tell you about the quality of the current assets. Some assets might be less liquid than others, which isn't reflected in the ratio. Now, there are two important considerations. Ratios should always be analyzed in the context of the company's industry, its competitors, and the broader economic environment. For diversified companies with multiple lines of business, it might be more appropriate to use industry-specific ratios for different parts of the company. And there you have it, a comprehensive dive into the balance sheet and all the critical components you need to know for the CFA Level 1 exam. We covered everything from intangible assets and goodwill to financial instruments, non-current liabilities, and the key analytical tools like common size analysis and ratios. Remember, the balance sheet is more than just a collection of numbers. It's a living document that tells the story of a company's financial health. As an analyst, your job is to read that story, understand the nuances, and make informed decisions based on what you see. So keep these tools in your toolkit, practice applying them, and you'll be well on your way to becoming a savvy financial analyst.